So let me give you a bit more definitions so that you be getting along, especially for those who are not familiar with the economic perspective. Now, what are stock? A stock, as I said earlier, is a share in the ownership of a company, basically a public traded company. Stock represents a claim to the whole company's assets and earnings. So once you own a stock or you trade in stock, it shows that you have a claim to the company's assets and earning. So once the company trade or do business and make profits, you are entitled to a percentage of the earnings of that company because you are a part owner of the company. So as an owner of that's a shareholder, you are entitled to your own share of the company's earning. Sometimes it can be profits, sometimes it can be loss. That's the game of business. Every time might not be a winning time. It's very rare, but sometimes you might have it so. But some other times it might not be so. So also you are entitled to a voting right attached to the stock. So as a shareholder, that's when you own a stock. I told you earlier, a stock is a share or is a percentage. It shows that you own percent a percentage of the company's assets, and it gives you entitlements to share in the earnings of that company. Now, not only the earnings, it gives you the voting rights. So you can make decisions on who is on the board of the company, who makes decision, who sits and take decision on behalf of the company, because whatever the quality of decisions that the management makes will determine the value of the stocks, determine how they appreciate, determine how they depreciate, and determine the level of dividends that is shared to each of the subscribers. So you will ask, why does company issue shares? Why do they issue share? Now, most times, some companies need to expand their company. Sometimes they start, maybe one, two, or three people start a company. They maybe start a private company, and the company begins to expand, expand, and expand. And for example, let me use Nigeria as a case study. Maybe you start in the city of Lagos, three people start a business in the city of Lagos, and they begin to get customers and customers, and they see the need that instead of serving only Lagos, we can serve maybe Abuja, that's the Federal Capital Territory, and maybe Kano, that's three places. Maybe they can be able to raise the money from their family and friends. Of course, they continue. Maybe in the next 3 years, they say, more people are looking at for our business. So what do we do? The next thing they do, okay, let's raise money. So they can raise money now by selling parts of the ownership of the company to people. So they use it as a form of borrowing money. They borrow money from the public by selling part ownership of the company. Once they sell this part ownership of the company, people buy in and they become shareholders. So they can use this money now, instead of staying and remaining in only 3 states in Nigeria, out of it 36 states with the Federal Capital Territory, which makes it 37. They can borrow money from people by selling their shares to them or part ownership of the company to them, and raise this money and expand to the 36 states, which gives them much more income. So by issuing this stock, the company does not have to pay the money back. They don't really have to be under the pressure of paying maybe the bank or people that borrow them the money. Instead, you become a part owner of the company, and the company does not bother of paying interest. Or the only thing they bother is managing the company well to be able to pay you, and run the company well to be able to pay you dividends. So what is dividend? Dividend is the money that the company pays to the stockholders, the shareholders. Stockholders can also be called the shareholders of the company from the profit it makes. So, as I said earlier, once they expand, just like the same example I gave earlier on, once they expand and there is need for them to get more and more things. You see that someone that was selling to only 3 states before now started selling to 37 states. It shows that there will be more income that will be coming in, more and more income. So when this more income comes, instead of them paying interest to loans, they now start paying dividends to their shareholders. But you should note that not all companies pay dividends to their shareholders. So the only way shareholders in these companies make money is to sell their stock at a higher amount than when they bought it at the open market. So as I said earlier on, there is growth stock and there is dividend stock. The growth stock, most times the company doesn't pay dividends. But when you buy, you can buy at the rate, let's use the dollar for an example. You can buy at the rate of $5, maybe in January, and in October, it might have appreciated maybe by 50%. Now, the price of the stock is now $7.5. That's $7.50. So that means you have made 50% of your money. So when you sell, you originally bought for $5. Now you're selling for $7.50. So it shows that the stock has appreciated. While in some other companies, it might buy the stock for $5. It might not really give any, or the stock might not appreciate from January to October. But by the ending of the year, they might give you what they call a dividend. That's profits that they make from running the company. So they might give you, let's say, 20% or 15% of, let's say 20% of the $5, which is recurrent every year. So maybe if the company makes profit this year, they pay 20%. Next year they make on that, maybe they make higher profit, they pay 25%. You see that you can be making, you still own your own share of the company, your own percentage share of the company, and you are making profits from the business that the company runs. That's what I mean by dividend stocks and growth stocks. So in summary, stock is ownership in a publicly traded company. Mark the word publicly traded company, not private companies. Private companies are restricted to some few individuals. If you look at example, the Nigerian Karma Act, I think about only 20 people maximum can own private company, can be the shareholders. But public traded company, the amount of ownership are unlimited. So stock ownership mostly is for public traded companies that are registered under the Nigerian Stock Exchange and registered also under the NDIC that protects consumers. So there are different processes that make them before they are accepted into these bodies, before the government allow them to receive fund. Then also stock is a claim on the company's assets and earning. So when you are a stockholder, you can lay claim on the company assets. Whatever belongs to the company, part of it belongs to you. And whatever profit the company makes, part of it belongs to you. Also, whatever loss the company makes, you will bear with it also. So it's a two-way thing. As they make profit, you bear. As they make loss, you bear. But the wise thing is, if you know the right companies to invest your money into, I think which will be coming up in the main class, and I will not want you to miss that, then you should be on the winning side always, smiling to the bank and making much more earnings, smiling with the profit instead of crying with the loss. Well, I believe that's the purpose of this class. So we're just here to show you this, and I believe when you join the main team, you should enjoy some benefits and privileges of how to get and make the right decisions. Now, the more stock you have, lastly, the more stock you have, the greater your claim as a owner. This is very, very important. Now, you look at let me give an example. Like, for instance, you look at Dangote, like the richest black man in the world. In Africa, sorry, I beg your pardon, in Africa. The richest black man in Africa. I'm not sure if he's in the world, but I'm sure for Africa. Now, he is the owner of Dangote. Dangote is a publicly traded, Dangote Group is a publicly traded company. So he's not the sole owner, but it's the face that represents Dangote. Why? It's because he has more shares or more stock than every other person has in that company. That's why he's seen as the face of the company. For example, also, Hess Holdings, that's the UBA group, is owned by Tony Elumelu, but it's a public traded company. But Tony Elumelu is the face of the company. Why is that so? It's so because he has more stock in the company than everybody else. So the more stock you have, the greater your claim as a owner in that company. So I believe with this little, you have learned much. Thank you.